Hi friends, welcome back to EduTap. So in the previous session we discussed about fundamentals of ratio analysis. Now in today's session we are going to discuss some practical problems based on the concept of ratio analysis which are going to be very much important for our examination. So let's start today's discussion. So the first question that we are having here is that we have to calculate quick ratio from the information given below. The information it is about current assets, current liabilities, inventories or stock or prepaid expenses. So now I believe that you have already understood really well all the different sets of ratios and their formulas that we discussed in the fundamentals वाला lecture. So अगर आपको fundamentals में थोड़ा सा problem है, formulas अगर याद नहीं है, so guys please go back to the previous lecture and try to memorize, try to learn, try to understand all the formulas once and then move on to this particular lecture. Then you will feel more confident about solving these problems. तो यहाँ पे हमारे पास जो क्वेश्चन है, so it is giving out different यहाँ पे indicators हमें दे रहा है और we have to compute the quick ratio. So let's try to compute it. Now these are the figures which are given in the question. We are given the current assets 4 lakh, current liabilities 2 lakh, inventories 25,000, prepaid expenses 25,000. Now we know that there are two sorts of liquidity ratios which are there. Okay, one is the current ratio. This is very simple, current assets divided by current liabilities. In this case 4 lakh by 2 lakh. And the another one is quick ratio or liquidity ratio, which is quick assets or liquid assets divided by current liabilities. Now the current assets and the quick assets, they are different. From the current assets we have to subtract what? We have to subtract stock and we have to subtract the prepaid expenses and then we arrive at the figure of quick assets. So what we have to do here, we have to compute the figure of quick assets and this is going to be how much? Current assets, that is 4 lakh. We have to subtract 25,000 of inventory and we have to subtract 25,000 of prepaid expenses. So this is going to be 3,50,000. Now we also need current liability and this is readily given in the question. So now we can easily compute the quick ratio 3,50,000, that is the quick assets divided by current liabilities, that is simply 2 lakh. So solving it, this comes out to 35 by 20 and this comes out to 7:4. If you solve it further, it would be 1.75:1. So this is going to be your answer. So after making all the calculations, the answer is going to be 1.75:1. So here the answer is option number A. Now the next question is calculate debt equity ratio from the following information. Okay, some information is given here and we have to compute debt equity ratio. Now debt equity ratio we have already understood in the previous question that it is a very important type of solvency ratio. The formula is very simple. The formula is itself debt divided by equity. We are given preference share capital, equity share capital, capital reserve, profit and loss account and 6% debentures also. So these are all the figures which are given to us and we have to find out the right answer. So we have already discussed about the formula. So you guys should go ahead and you should try to attempt this one first before moving on to the solution of this question. So let's try to solve this particular problem. Okay, the debt equity ratio, the formula. The first thing is to remember the formula. Debt equity ratio, the formula is long-term borrowings, long-term funds divided by shareholder funds. Okay, and how do we compute the shareholder funds? The shareholder funds, they include equity share capital plus preference share capital plus all the reserves in surplus. So in this particular problem, okay, in this particular problem, the shareholder funds are going to be how much? Equity share capital is 5,50,000. Preference share capital is 1,50,000. Reserves and surplus, we have one capital reserve which is there, 2 lakh. And we also have the balance of the profit and loss account, which is again a type of reserves or surplus which the company has generated. So if we add all of these, this would be 550 plus 1.5. This is going to be 7 lakh plus 2 lakh, 9 lakh plus 1 lakh, that is 10 lakh. So 10 lakh is going to be the denominator. And long-term borrowings are going to be how much? Long-term borrowings are simply going to be the debentures. So this is going to be 2,50,000. So if we try to compute the ratio, debt equity ratio, this is going to be 2,50,000 divided by 10 lakh. So solving it, it would be simply 1:4. Okay, the ratio is going to be 1:4, or you can say 0.25 is going to be the ratio. So now we have solved the question here and you can see that the answer is 0.25 as is being solved here. So definitely we can mark out option number B as the right answer to this question. Now let's move on to another very interesting problem that is given here. We have to calculate a debtors turnover ratio from the following information. Okay, now this information is with regard to debtors opening balance, closing balance, bills receivable opening balance, closing balance, the total sales, sales return and cash sales, and we are given different options as the answers. So we already know that turnover ratios, they are computed to know the activity of the company, whether the company is effectively utilizing its assets or not. The debtor turnover ratio, it tells us whether the company is effectively collecting the money from its debtors or not. Now for this particular ratio, we have to remember the formula, apply it, and we would get the right answer. So again, you guys are already aware about the formula, so just give yourself a head start and try to solve this problem first before jumping on to the answer. Now let me try to solve this particular question for you guys. Okay, so this question is about debtor turnover ratio. So first and foremost, you must know the formula of it. Formula is net credit sales in the numerator, and in the denominator you have average receivables. Okay, the average amount of money that you have to receive. Now the average, it simply means, okay, do remember it, it simply means opening plus closing divided by 2. So this means average. And by receivables, we mean the money which we have to receive on account of the sale of goods. Now this money, it may be sitting in the balance sheet in the form of sundry debtors, or it may be in the form of bills receivable. Okay, the bills on which we have to get the money on account of sale of goods. So they are the bills of exchange, which are referred to as the bills receivable. They are again a type of the asset, or again a different type of debtor. So we have to include in the receivables debtors as well as bills receivable. So both of these, they are to be included. And for net credit sales, how we would be computing the figure of net credit sales? In the question we are given 7 lakh is the total sales. Okay, 7 lakh is the total sale. We have to compute net credit sale. On one side we have to compute credit, and on the one side we have to compute net sales. So net sales means sales minus sale return, and credit sales means the sales which are not on cash. So from the sales figure of 7 lakh, we have to reduce the sales return, the sales which were made, but eventually the goods, they were returned. So we subtract it, and again we subtract the cash sales which were made, because we have to only consider the credit sales here. So if we subtract these two figures, we would get the net credit sales which were made. So this is going to be 5,80,000, and the denominator, let's compute it as well. So opening balance of debtors and receivables, we have 90,000. And closing balance of debtors and receivable, totaling them, we have 1,20,000. So this is going to be 90,000 plus 1,20,000 divided by 2. So if you solve it, 2,10,000 divided by 2, this would be around 1,05,000. Okay. So if we compute the debtor turnover ratio now, this is simply going to be how much? Simply going to be net credit sales, which is this figure, 5,80,000 divided by 1,05,000. Okay, so this is going to be it. Now if we take a look at the options which were given, the options, they were given in the approximate terms. Okay, if you solve it, this is going to be 580 divided by 105. Okay, 580 by 105, this is coming out to be the answer for this particular question. Do not solve it further, just look at the options which give you the approximate correct answer and mark it as the right answer. So this is how this problem has been solved here. So if you wanted a ready-made solution for it, this is what you can read and follow. Okay, so now debtor turnover ratio, how much the answer is going to be? Okay, we computed 580 divided by 105, 5,80,000 divided by 1,05,000. So this is what we were getting. Okay, so how much this is going to be in approximate terms? 105 into 5, 105 into 5, this is going to be how much? This is going to be 525. Okay, so if we are going to just solve it, so this has to be 5 first. So this is going to be 5 point something. Okay, 5 point something. If we do the 6, then it would cross 580. So this has to be 5 point something, And the only option number C, it is about 5.5 times. So you have to mark the answer as option number C. Don't waste your time computing each and every figure, because if you solve this particular problem and waste your time in it, this is simply going to be of no use for you. So just mark the right answer as the 5.5 times, approximately option number C. Now let's move on to the next question. Calculate the earning per share from the following data. So now you guys should have to take the lead here. Net profit before taxes 2 lakh, taxation 50% of the net profit, 10% preference share capital rupees 10 each, rupees 2 lakh, equity share capital rupees 10 each, rupees 2 lakh. So how much is going to be the earning per share? We have already talked about the different profitability ratio. One of the ratio is earning per share, and it tells us how much earnings we are generating per share in the company. So let's try to compute it. So in this question, these are the figures which are given to us. Okay, we have to compute earning per share. This earning per share, the formula is profit which are there for the equity shareholders divided by the total number of equity shares, the number of shares that we are having. Okay, now the numerator and denominator we have to find out here. It is very easy to find out the denominator, how much number of shares we are having. We are given equity share capital rupees 10 each, rupees 2 lakh. Okay, we are having 2 lakh of the equity share capital, one share is of rupees 10 each. So how much shares we would be having? We would be having 20,000 shares of each rupees 10. So this would be the number of equity share. The earning per share, it is only computed in respect of equity shareholders. So we are only going to consider equity shares in this particular case. So number of shares already found out, this is going to be 20,000. So now we have to work the profit which is available for the equity shareholders. So the residual profit, whatever remains with the company, this is something which belongs to equity holders. After making all other dues, after paying all other dues, the money that is left, this is for the equity holders. So now in this particular case, we made a net profit before taxation of 2 lakh. Okay, this is net profit earning before taxation. From this, first we would have to deduct interest if any was there. Interest is not given here, but we are given the figure of taxation. We would have to pay to the tax authorities, which is 50% of the profit. So of the 2 lakh, we have to pay 50%, that is 1 lakh. So balance we would have, we would have profit after tax is going to be 1 lakh. And out of this balance 1 lakh, we first have to make payment for the preference dividend. Okay, preference dividend, they are given preference as compared to equity holders. So their dividend is paid first. So 10% preference share capital of 2 lakh. So it means we have to pay 10% dividend to them. 2 lakh, 10%, it becomes 20,000. Okay, 2 lakh ka 10%, it is 20,000. Subtract it. So the balance, it comes out to 80,000. So this is something which is there for the equity holder. So this is profit which is ultimately available for the equity shareholders. So if we compute the EPS now, this EPS is going to be profit for equity holders 80,000 divided by number of shares, which is 20,000. You can easily solve it. This is going to be 4 per share. So this is how the detailed calculation is done. So you can read this as well if you wish to. So as we have solved, the answer is going to be option number D, rupees 4 per share. So now let's move on to the next problem. This is if operating ratio of an enterprise is 70%, its operating profit ratio will be. Options are 30%, 35%, 15%, 70% or data inadequate. So I believe if you have understood the operating ratio and operating profit ratio, the concept of both of these you have understood, it would be very easy to find out the answer to this particular question. So let me try to explain the things here in a much simpler perspective. Okay, if we are preparing a statement of profit and loss, on the top we have revenue from operations. So let me suppose it is 10 lakhs. From this we are going to deduct the cost of the revenue, the cost of the goods sold. So let's suppose it is 6 lakhs. Okay, we get the figure of gross profit. This gross profit is going to be 10 minus 6, that is 4 lakh. And from it we subtract the operating expenses, the normal day-to-day operating expenses of the entity. Suppose they are 2 lakhs. The balance figure, it is going to be operating profit. The balance figure, the remaining figure, it is going to be operating profit. 4 minus 2, this is going to be 2 lakhs. So now let's compute the two ratios. Number one, let's try to compute operating ratio. And number 2, let's try to compute operating profit ratio. Now you guys are going to tell me the formulas of both of these. Okay, for the operating ratio, the formula is cost of goods sold plus the operating expenses divided by your revenue into 100. Now in this particular case, cost of goods sold is 6, operating expenses they are 2 lakh divided by the revenue, which is 10 lakh into 100. So 8 divided by 10 into 100, this is going to be 80%. Okay, we multiply by 100 for percentage. So the percentage is going to be 80%. Operating ratio is 100%. How much is going to be the operating profit ratio? This is operating profit divided by revenue into 100. Operating profit is going to be how much? We are given 2 lakh. Okay, we have computed 2 lakh divided by the revenue 10 lakh into 100. To compute in percentage terms, this comes out to 20%. So a very important conclusion can be drawn out of it here. Let's see if you can get it right. 80%, 20%. Can you see a relationship here? Can you see a relationship here? Yes, we can definitely see a relationship here. I can totally say that operating profit ratio, okay, pardon my handwriting, okay, I just don't have to write this much, 100 minus operating ratio. Operating profit ratio is how much? 100 minus operating ratio. So this is a very important conclusion can be drawn out of it. So if we have operating ratio is 80%, operating profit ratio is going to be 20%. So this is something you have to remember. So this is also explained here. Operating profit ratio, operating profit by revenue into 100. Operating profit ratio can also be computed in this way, 100 minus operating ratio. So this is explained also here. How would you compute the operating cost? How would you compute the operating profit? And how you can just add the two to obtain the figure of 100%. So you can easily apply this particular formula in any problem if it is being asked in this particular manner. So for this question, if it is given that operating ratio of an enterprise is 70%, operating profit is going to be how much? Operating profit is going to be 100 minus 70, that is 30%. So answer is going to be definitely going to be option number A. So thank you friends. This was all about our discussion on the practical problems on ratio analysis. So this is it for today. Thank you. Bye bye. Take care. All the best and keep working hard.